Business 506, Individual Risk Exposures. By the end of this lesson, you should be able to describe the major categories of insurance, understand the benefits and costs of insurance, and discuss the major risk exposures that are faced by individuals and businesses. In the major categories of insurance on the personal side, we have life, health, disability, homeowners, personal article, and umbrella liability insurance. On the business insurance side, we also have business life, business health, disability, commercial property, commercial auto, commercial umbrella liability insurance, workers' compensation insurance, and also business interruption insurance. We have social insurance, defined as Social Security, Medicare, unemployment insurance, temporary disability insurance, and workers' compensation insurance. Some of the benefits of insurance: it encourages peace of mind, pays losses, increases marginal utility of assets, it takes a small amount from all policyholders, referred to as the premium, and pays the severe losses suffered by a few people. It also provides a basis for credit, stimulates saving, provides investment capital, offers advantages of specialization, and fosters loss prevention. Some of the costs of insurance are the operating costs of the insurers, the profits of insurers, opportunity costs, use of capital, personnel, and materials by insurers that could be used elsewhere, increased losses through fraud and carelessness, and adverse selection that produces poor loss experience among those insured. The insurance equation. This is also known as a combined ratio. We take the premiums plus other income, and from that we take out the actual claims paid out, the loss cost, take out the insurer's overhead, that's for the physical buildings, personnel, everything that goes in with running a business. We add or subtract the investment returns for the policy period, and we end up with a net profit to the insurer. Some personal risk exposures. Personal risks relate to the loss of ability to earn income, and they also include death, disability, poor health, unemployment, and outliving one's capital. Regarding death and risk, there is absolutely no risk exposure associated with death because it is a certainty. We will all die at some point. The risk exposure is associated with premature death, dying when you're in your peak income earning years, for example, and the adverse impact to your family. And we just touched on this in the last slide. The essential ingredient in risk, the risk exposure associated with premature death, is the existence of someone who would suffer deprivation as a result of the individual's death. The risk exposure associated with premature death include your final expenses, the funeral and burial needs, uninsured medical bills, debt retirement, these can be mortgages, student loans, auto loans, credit cards, estate settlement and taxes, and attorney fees. Additional risks associated with premature death include the needs of the surviving spouse, children, and other dependents, financial needs such as basic food and shelter, healthcare needs, and educational needs. Additionally, the emotional needs of the family to heal after the death of the family member may be difficult to quantify at times, but they're also very real. The chart below shows you the odds of dying prior to age 65. Within a given year, you'll see that at age 25, 35, 45, 55, and 60, there's a gradual upward trend of one passing on as one gets older. And taking a given age band, for example, age 25, the odds of passing on prior to age 65 are 19%. And you'll see, as we progress in age, on that right-hand column, the closer we get to 65, the less of a chance there is to pass on before age 65. Regarding disability, disability exposures arise to accident and illness, with either resulting in the inability of a person to work. Unlike the essential ingredient in risk exposure associated with premature death, the disability exposure is fundamentally different because the disabled person will need income during the period of disability. The risk exposure associated with disability include loss of income, special health care needs, nursing care, rehabilitation care, and increased medical expenses. Now in this chart, you'll see the odds of a 90-day disability prior to 65, that the younger you are, it's a greater possibility of that happening. As we get close to age 65, that probability of being disabled, well, there's a shorter window to become disabled in the closer we get to that age, and you'll see the probability decreases over time. But when you look at the overall numbers, compared to the prior slide that had the odds of dying at a given age, you're much more likely to incur a 90-day disability while alive than dying at a given age. The topic of poor health. Loss exposures associated with poor health are just as important as those that arise due to premature death. Unlike premature death, however, loss exposures from poor health are usually temporary. Some risk exposures with poor health. These exposures include medical care expenses, hospitalization, physicians and surgeon services, dental care, prescription drugs and other expenses, mental health services, and long-term care, also known as custodial care. And that can be medical or non-medical. If it's on the, well, custodial would be non-medical. There's also loss of income. On the topic of unemployment, loss exposures associated with unemployment are generally limited to loss of income, but may include psychological issues as well. At any one time, approximately 4 to 7% of the U.S. workforce is unemployed. Some risk exposures with unemployment. When we analyze one's exposure to income loss due to unemployment, individuals should become familiar with unemployment laws in effect for the state of their residence. State unemployment insurance generally provides only a floor of protection and is usually insufficient to replace the income loss. Regarding retirement, the concept of outliving one's capital is one of the greatest unknowns facing retirees today. Loss exposures associated with retirement include many of those previously mentioned regarding financial, healthcare, and emotional needs. A complicating factor in analyzing the risk associated with retirement is that we don't know how long that we're going to live in retirement. The risk of living too long and outliving one's financial resources, which is known as superannuation, is a serious issue. Other retirement risk exposures, accurately estimating the accumulation need during the working years, and outliving retirement accumulation. The concept of sustainable withdrawals in retirement is not mentioned here, but that is one dealing with that second bullet point of outliving the retirement accumulation. It's one that there are many topics, many articles on, and I encourage you to research on your own. As an estimate, the accumulation need is roughly 70-80% of pre-retirement income. Ideally, the retiree will spend the amount accumulated over their lifetime such that the final check to the mortuary for the burial expenses will bounce. Regarding property risks, anyone who owns property faces risks simply because such possessions can be destroyed or stolen. Property risks embrace two distinct types of loss: direct loss or indirect or consequential loss. Regarding direct loss, that can be defined as a loss that arises first or immediately following the occurrence of a peril. For example, the cost to repair a dented fender following an automobile accident is a direct loss. Indirect or consequential loss is a loss that arises only as a secondary result following the occurrence of a peril. For example, the additional living expenses a family incurs to pay for substitute living accommodation following fire damage to their home. Regarding real and personal property, real property is land and anything that is growing on it, erected on it, affixed to it, or inherent in the bundle of rights associated with ownership. Personal property includes anything that is subject to ownership and is not real property. Some property risk exposures include fire, earthquake, lightning, theft, loss of use, flood, vandalism, collision, malicious mischief, and other additional expenses. Some liability risk exposures arise from injury to another person or damage to their property, either intentional or unintentional, through negligence or carelessness. Liability risks therefore involve the possibility of loss of present assets or future income as a result of damages assessed or legal liability arising out of either intentional or unintentional torts or invasion of the rights of others. there are two types of liability risks: bodily injury and property damage. Bodily injury results when a person suffers bodily harm, sickness, or disease and includes required care, loss of services, and possibility of death. Property damage results from the destruction or damage to real or personal property. Other types of liability risks, we have personal injury, results from actions such as invasion of privacy, defamation of character, malicious prosecution, libel, and slander. We also have contractual liability, results from breach of contract, responsibility for damage to the property of others in one's possession, and also implied warranties. Spend a little time here on this flowchart. If you look at starting with a legal wrong, the first question is it public or private, meaning criminal or civil? If it's a criminal wrong, it can result in criminal actions and liabilities by the government. The state will prosecute you. A civil wrong, also known as a tort, or on contracts. You'll see in the middle category there, a tort can be intentional acts or omissions, unintentional acts or omissions, negligence, strict or absolute liability. And you'll see beneath there are various types of items listed. So under intentional acts or omissions, we have assault, battery, false arrest, fraud, libel, and slander. The middle column there, unintentional acts or omissions, negligence, contributory negligence, comparative negligence, presumed or imputed negligence, and strict or absolute liability, aircraft, animals, blasting, water, workers' compensation. So that's on the tort side. Going to the far right side of the screen, you'll see based on contract. And within that, we have implied warranties, breach of contract, and Bailey's responsibilities. All of those individual examples can result in civil actions and liabilities by the injured parties. Regarding tort liability, it is an injury or wrong committed against an individual that arises out of actions other than breach of contract. Regarding negligence, we define that as an unintentional tort in the form of an action or omission that leads to the personal injury of another party. Continuing on with negligence, it's the failure to exercise the proper degree of care required by the circumstances. It consists of not doing what was required in the circumstances or doing something that should not have been done. Examples of a negligent act: a certain standard of care owed to others. That standard of care is not met. As a result, there is injury or damage, and failure to meet the standard of care is the proximate cause of the injury or damage. Regarding contributory negligence, it is the legal principle whereby an injured person cannot recover damage for injuries from another negligent party because the injured party was also negligent. For example, Sue, who was legally drunk, was injured when John lost control of his car and ran into her. There would be contributory negligence in that situation because if she was sober, she may have been able to avoid the accident. Regarding comparative negligence, it's the legal principle whereby an injured person can recover a portion of the damage for injuries from another negligent party if the injured party was also negligent. So if you are determined to be 40% negligent for the accident, you could only recover 60% of your damages. Presumed negligence can be defined as assumed from the facts of certain situations. For example, Sarah, who underwent an operation on her left knee, ended up having a gallbladder removed by mistake. It's just, in that situation, the presumed negligence was that the surgeon failed to operate on the correct part of the body. Imputed negligence is the legal responsibility extended by courts to persons other than those who cause injury. For example, although Joe, a minor, was driving the car of his parents, they were held responsible for the damages that resulted from the accident. Another concept is last clear chance, which can be defined as the last clear chance doctrine is the legal principle which holds that although the claimant is negligent, there is liability if the defendant had a last clear chance to avoid the accident. So, although Sue was legally drunk when John accidentally ran into her, he could have avoided the accident by swerving to miss her. Some business-related risk exposures. In addition to the various risks mentioned previously regarding personal property and liability risks, business are exposed to risk. They can be contractual liability, employer-employee liability, completed operations and products liability, professional liability, principal agent liability, fiduciary liability, and pollution liability. There's a calculation of damages, and those come into three categories: special, general, and punitive damages. Regarding special damages, those are things that can be quantified, such as a car worth $10,000 that was totaled in an accident, a doctor's bill for $3,000 to fix a broken leg. Again, quantifiable and special. General damages are those that can't be specifically measured, so compensation for pain and suffering, disfigurement, or loss of companionship. Now, the last type, punitive damages, are designed to punish, and those are not covered by insurance. So, for example, if you're drunk driving and you get into an accident, your insurance company generally is going to handle the liability for the other party's injuries. But if the court says that because of your drunk driving, you have to pay $10,000 in punitive damages, your insurance company is not going to cover that. That will come out of your pocket. So to summarize, in this lesson we learned about the major categories of insurance, the benefits and costs of insurance, and the major risk exposures that are faced by businesses and individuals. Thank you for your time.